What fix and flip lenders really care about. One of the most common mistakes I see among newer fix and flip investors is evaluating lenders primarily on interest rate. While rate is important, experienced lenders are focused on something entirely different: execution risk. Before approving a loan, lenders are evaluating whether the borrower has the experience, liquidity, and ability to successfully complete the project. Understanding that distinction can help investors secure financing and help brokers position transactions more effectively. The first question many lenders ask is simple: who is actually driving the project? There is a significant difference between an experienced investor, a general contractor acting as sponsor, a passive capital partner, and a first-time flipper. Lenders want to understand who is making decisions, managing contractors, controlling budgets, and overseeing the renovation process. The stronger the operator, the lower the perceived risk. The next question is usually, how recent is the experience? Many borrowers tell lenders they have completed 10 or 20 flips. That's great. But if those projects were completed 10 years ago, they carry less weight than projects completed within the last few years. Markets change. Construction costs change. Contractor availability changes. Lenders want evidence that a borrower can execute in today's market. Liquidity is another major consideration. Every renovation project encounters surprises, unexpected repairs, permit delays, contractor issues, cost overruns. Lenders want confidence that borrowers can continue making interest payments, fund unexpected expenses, and carry the property if the project takes longer than expected. Many fix and flip projects fail because the borrower runs out of cash, not because they run out of equity. Of course, the deal itself must also make sense. Lenders evaluate purchase price, renovation budget, after repair value, leverage, and exit strategy. Strong sponsors can improve a lender's comfort level. They cannot rescue weak economics. A successful fix and flip requires both a capable operator and a viable project. This brings us back to interest rates. Many investors spend weeks comparing rates while overlooking factors that can have a much larger impact on profitability. For example, how quickly does the lender process draw requests? How long does it take to release funds? How efficiently are inspections handled? A slow draw process can delay contractors, extend timelines, increase carrying costs, and reduce profits. The same applies to certainty of execution. The lowest rate means very little if the lender cannot close on time. Missing a purchase deadline or losing a deal because financing falls apart can cost far more than a slightly higher interest rate. The most successful investors evaluate lenders based on experience, reliability, responsiveness, draw administration, and certainty of execution, not just pricing. When lenders evaluate a fix and flip transaction, they are not starting with rate. They are evaluating the sponsor, recent experience, liquidity, project economics, and the likelihood of a successful exit. For borrowers, rate matters. For lenders, execution matters. And in many cases, the lender with the lowest rate is not the lender that delivers the best result.